Hello and welcome to another in McDermott, Will, and Emery's Thursday seminars addressing topics in renewable energy and the energy markets. Today's topic is tensions in renewable energy and the environmental markets. I am Ed Zelke. I am Global Head of McDermott's Energy Project Finance Practice, and I want to welcome all of you to today's program. I also want to remind you that we have a Q&A feature at the bottom of your screen. So if you have questions for our guests today, please use that to ask questions in real time, and we'll do our best to get those answered or follow up with you afterwards. Joining me today is my partner from our New York office, Jacob Hollinger, and he will be joined by our special guest, Jonathan Bernstein of Carbone. Carbone is a financial services provider geared toward the energy and environmental markets in the U.S. and Canada, with specialties in commodities, brokerage, capital markets advisory, and research. So I'd like to welcome Jonathan, and Jacob, let me turn it over to you.
Thanks, Ed, and thanks to everyone for tuning in today. It's my great pleasure to introduce Jonathan Bernstein. Jonathan is a graduate of Tufts in Columbia. He has fairly extensive experience in the carbon markets, and more recently is now the managing partner at Carbone, where he leads the firm's award-winning commodity brokerage and research groups. Very extensive knowledge of basically all U.S. energy and environmental markets. So when I originally thought and talked with Ed about this program today, I had thought it would be interesting to talk about carbon offsets in particular and what impact, if any, COVID is having on the carbon offset market. But in speaking with Jonathan, it quickly became apparent it would be wise and I think fruitful to kind of place that in a larger context of, as Jonathan puts it, kind of tensions in the environmental markets and commodities markets, and in the context in particular of ESG, or environmental, social, and governance related investing, and some recent policy developments. So I think our conversation today will be largely about that kind of ESG context, what's happening with it now, and we'll talk about some policy issues, and we should get in also, hopefully time permitting, to some more granular level issues like carbon offsets. So before I turn it over to Jonathan with some questions for him, let's start. We have two quick polls for the audience to get a kind of measure of the polls. First question is, what impact is COVID-19 having on ESG investing? Got a variety of answers here, ranging from none, slowing it down, but the interest in ESG will reemerge, shutting it down for good, or making interest in it grow more than ever. Why don't we give people 10 seconds here to answer that. Okay, and here we have the results. It looks like a pretty substantial majority thinks that it's slowing down, but it's going to come back. I'd be curious, Jonathan, to see if that's your take on things as well. And another significant 30% or so says that it's the interest in it. Maybe this episode, unfortunate as it is going to have drive ESG more than ever. We have one other poll here, Marina. Why don't you put that up if you could? So here our question is, with renewable energy prices continuing to drop and wind and solar now being extremely competitive all across the United States on price level, and global greenhouse gas emissions also expected to decline pretty significantly in 2020, what does the future look like for carbon offset credits? About the same as before, rapidly dimming, or so bright we need to wear shades? And here, most people thinking that it's a majority, a little more than 50%, thinking it's about the same as before, and then more or less evenly divided between, there's less interest now in carbon offsets than before, and and know we're going to have still pretty significant interest in the topic. So with that context, that gives us a little insight, Jonathan, into our audience. Let me kind of set up a first question for you about ESG. Pre-COVID, there was just real blossoming interest in ESG investing, and not only in the amount of money flowing in there, but also the number of metrics and indices that measure it. And then kind of more specifically, a huge interest in carbon neutrality. And, we're seeing a lot of announcements of companies like JetBlue beginning 2020 announcing we're going to offset all of our carbon emissions from our flights. Many other companies making those types of announcements and commitments. And also a lot of interest in corporate renewable energy PPAs. So now with so much of the economy having been disrupted and shut down, including the renewable energy sector, but by no means only that. I mean, what now? What do you see happening now? What does the future bring here?
Sure. Thank you, Jacob, and thank you, Ed. There's a lot to talk about here, of course. I did vote in the polls, and I think you'll see how I swung. As far the short answer is, it sort of depends on how you define your terms. Broadly, the news is great for ESG. We need to unpack that and better define our terms. But as far as ESG investing goes, honestly, if anything, we are seeing a compounding sort of concentrating dynamic, a self-reinforcing positive performance that's been ongoing. And relative to other metrics, for example, the S&P, ESG is outperforming. We can point to any number of ESG funds that are net positive in 2020 against the S&P, which is still, as hard as it tries, net negative on the year. In Q1 of this year, we noted in an article recently in S&P, there was something like $10.5 billion in net inflows into ESG funds in Q1 versus any number of records of net outflows from the overall fund market, particularly ETFs. And from a renewable energy perspective, which is primarily our domain, the story's even better. 2019 was the first time in 130 years that the US renewable energy consumption market surpassed that of coal. If you look at the price curve over the past 18 months for the predominant renewable energy credit markets, the trend line goes like this. Whereas if you look at the price curve for power, for better or for worse, it kind of goes like this. And so the news is good. And I think that's, particularly at a time like this when there's a lot of, trials and tribulations out there, I think good news comes at a premium. Now, as far as how I think we need to unpack the terminology, a couple things, and we can go in any direction you'd like from there. ESG is a broad concept. The E is doing great, as I've mentioned. Clearly, I think the S and G are having a harder time. That seems very evident, certainly from where we're based in Midtown Manhattan. But the E doing quite well, and we could talk about that quite a bit. The other thing that I'd like to flag here as an important nuance is that ESG investing is great. It's very impactful. It is different, categorically different than offsetting or greening. And, for a shop like ours that specializes in this stuff, it's very important to flag that difference. And again, we can talk about that more.
Yeah, I mean, Jonathan, maybe you could say a little bit more about what you mean there as the difference between those things.
Sure. So I'm sort of channeling Charlie Munger here, who I think had similar commentary on, Al Gore's very famous early, fund that was oriented towards ESG. But ultimately, ESG investing is an investment oriented on, positive returns based on the performance of companies and perhaps products that meet certain environmental, social, and governance related metrics. That's an investment. Offsetting involves essentially buying instruments and retiring them and using them that help account for one's carbon footprint, one's energy profile, whatever the framework is that you're trying to offset or otherwise green. You kind of need to buy those attributes: renewable energy credits, carbon credits, the renewable PPAs that we've talked about. There's a variety of ways, and the good news there is there's a lot of different ways to do that. A lot of new innovation and very interesting and meaningful ways to achieve that end, but it's different, and I think that's important. When you invest in companies that are ESG conscious and active, and the tech stocks I think are a great example. Investing in Microsoft and Apple and Google and Facebook is it's great, but just because they offset their footprint doesn't mean that you've offset yours by buying their stock.
Got it. So you're pretty bullish, at least on the environmental side of ESG. I mean, what about the kind of carbon neutrality trend, and especially in the voluntary markets? Or although don't limit yourself if you want to go beyond that. But what about that carbon neutrality trend and the interest in establishing carbon neutrality? Where do you see that going at this time?
Sure. We sort of on the one hand, need to sort of package those concepts together. So the proliferation of renewable energy, the growth of the carbon offset market, and the voluntary participation in renewable energy and decarbonization markets. So the growth trend within that composite overall is extremely positive. And you can use any number of metrics to point to why. I do want to say that's a little bit different than talking about the price of a given carbon credit or otherwise. Because again, it's not exactly unless you're investing in a business that's in the business of producing and selling carbon credits, that's less of what's important overall than from a voluntary market perspective, looking at the growth of the market. Right. And so, looking at some of the metrics in that context, it's all very bullish. Renewable energy investment in 2019, I jotted a note here, hit over $280 billion. There were some stutter steps in certain markets abroad, China and India in particular, but in the US, I believe that represented 28% growth. And, of that total, 55.5 billion, was invested in US renewable energy markets. I already pointed to the fact that for the first time, for all intents and purposes ever, renewable energy consumption in the U.S. outpaced that of coal. And then switching gears to be a little bit more specific on the voluntary market, the growth of the number of renewable power purchase agreements from corporate and non-corporate end users, the growth of voluntary renewable energy credit markets like the Green E market that's run by the Center for Resource Solutions, compliance markets. They're all on a very clear growth pattern, which again, if anything, COVID has kind of amplified, at least relative to the rest of the market. Because, it's important to recognize that this is in a way, it's a captive demand. Right? So within the compliance markets, renewable energy credit targets, the obligations, they're on a scheduled incline over time, right? So even if the market itself is flat, if power markets are flat or even declining, the value of that instrument and the size of that market is growing over time. And so that's really throughout the industry.
Got it. Are there any contrary indications, any kind of headwinds or hurdles that we got, that the sector has to think about?
Sure. Yeah, that's really, I'm glad you asked, because it's important. There are, of course, challenges to the continuation of that growth. I would flag that in the context of, an investment, the value of that investment will rise, even if the growth is potentially slowed. But focusing on growth for a moment, there are definitely speed bumps on the horizon. And the biggest place that we see this, and perhaps this was the primary reason why we titled this, tensions in renewable energy markets, because again, generally the news is good. But where you're seeing a little bit of tension is in the policy domain. So a few hallmark instances of that sort of budding of prerogatives. It's particularly between the federal level and the state level. In PJM, the largest deregulated system operator in the country and I think the world, the FERC, the federal agency that administers over power markets, has essentially called into question the capacity market paradigm precisely because of state subsidies for certain resource types, particularly renewables, also nuclear. The hallmark acronym is MOPR, M-O-P-R. This has presented such a distinct butting of heads between federal and state prerogatives, federal desire to run a fair, I suppose, energy and capacity market, and state prerogatives as far as encouraging resource types that are favored. This has led to key markets within PJM, the largest markets, New Jersey, Maryland, Illinois, and a few others, to consider leaving the capacity market. And we're in the midst of coming up with a whole bunch of potential, resolution and compromise measures to keep the market intact. But there is a distinct probability that the tension there will result in a complete change in how the PJM capacity market is run. You see that in some other areas, net metering. There's a move, federally to either dismantle state level net metering or otherwise federalize it. That is at odds with state level prerogatives, which have been, thus far very successful in executing on, net metering, market programs. You see that in the fuels market as well, but the RFS versus the state level LCFS markets. The one big exception is tax credits, and I believe you guys had put out some stuff on this recently. The Section 45Q carbon capture and sequestration, tax credit regime. The recent ITC and PTC, tax credit eligibility extension. The biodiesel tax credit reinstatement and extension. That's one area where there's, folks are pretty well aligned. But,
right. So a couple questions have just come in about acronyms while you were talking. One was about MOPR, M-O-P-R. I think that's minimum offer price rule, if I'm not mistaken. RFS being renewable fuel standard, LCFS being low carbon fuel standard out of California. Do you think the trend is strong enough that towards renewable energy, just the price, the competing on price alone, that maybe this kind of fluctuations that we have in renewal of the PTC, for example, for wind, is going to be less significant? Historically it's been a significant driver of new growth, but now maybe we've reached a point where do you think the industry can maybe weather or do better without even without the tax credits? I don't want to say, I think we're all in favor of the tax credits continuing, but if they were to be not renewed in some way, how do you see that playing out?
It'll present a challenge to continued growth, but broadly, I don't want to take too strong of a stance. If anything, I think you guys would have a better opinion on exactly how it would unfold as far as federal versus state tensions. But everything that we're seeing looks like state prerogatives will prevail. And broadly, the market programs that exist will accommodate for disruption, like you're describing. So if the $23 a megawatt hour PTC goes away, and whatever happens within the power market, it seems logical that the REC market or the otherwise sort of qualitatively driven market for that product will rise, right? The price of the rec will rise to the point where it will make up for that gap. We haven't seen any reason to expect that will present hiccups for sure in the midterm. But on the long term, if anything, that'll just redouble the momentum behind that particular asset class.
Let me shift gears a little bit and ask you a little bit specifically about the voluntary market. The voluntary market for either an interest in carbon neutrality, an interest in purchasing carbon offsets, like you have. You kind of have two segments of that market. You have your big industrial companies or big commercial companies, like I mentioned the JetBlue announcement at the beginning of the year. Sure. You also have individual consumers, wanting to offset their flights. And where do you see that? Do you see, and let me maybe put a little more fine point on it. I mean, with so much social turmoil right now in the country, do you see kind of a shift away from that kind of voluntary environmental focus to a more focus on social justice? Driven investments?
It's a great question, and we started with that kind of at the top of the conversation here. The S&G parts of ESG clearly are challenged. I don't have a great answer there. I don't. I'm not sure who does.
Yeah,
I think there will definitely be redoubled focus on those metrics, without a doubt. Exactly how that plays out is unclear. But coming back around to the E, which is the part that I, can speak to with authority, there are definitely, the market it's not homogenous, or I should say the economy and its approach to, renewable energy and decarbonization, it's not homogenous, particularly challenged segments of the economy, like the airlines, who made really big and bold commitments to decarbonization or, offsetting their footprint late last year and early this year, pre-COVID. They've been hit the hardest from an economic perspective. And it is hard to imagine them moving forward with the previously made commitments on the same timeline. Do I think they go away? No, definitely not. But do I think they get delayed? Probably.
Do you have any advice for people in the kind of renewable energy development space? We service a lot of developers as a firm. I don't know how many are necessarily on the call today, but thoughts on like where developers can go to kind of take advantage of the emerging ESG trend once it starts picking up again, or it's already bright, but as we come out of COVID, hopefully, and bring some of these other issues under control. Any thoughts on how to take advantage of those trends?
Sure. They should go to Carbone Inc. and McDermott, Will and Emery. So although I mean that, joking aside, look, the energy mix, I used to say the energy mix of the future, but it's no longer the energy mix of the future. It is the energy mix of today, is one where the value of the attributes, whether it's renewable attributes, whether it's resiliency and grid reliability attributes, whatever they are, whether it's tax attributes, is as valuable, if not more valuable in their composite than the underlying physical commodity, whether that's electrons, whether that's molecules. And there's opportunity out there, without a doubt. There are incentive programs and a myriad, set of incentive programs. Companies can and are positioning themselves to take advantage of those incentives and to ensure long-term returns based off of the revenue opportunities that are out there. And so just staying smart on, the policy evolution and, those trends, I think is really what it comes down to. And of course, smart service providers can help with that.
Right. Let me jump around a little bit. I mean, do you see a few years ago, we really saw a proliferation of energy service companies, ESCOs, and new business models along that. Do you see a kind of proliferation of new models like that coming in? And if you have any thoughts on that topic.
Definitely. Nonstop innovation in the sector. It's very, I mean, again, particularly at a time like this with so much, such a troubling atmosphere out there in so many different ways, it's very heartening within our sector because it's sort of constant cycles of innovation and new development. So, you see things like energy efficiency and lighting as a service. You see, electrification of vehicles as a service. Just many waste to value trends. That's been a really exciting, growth area for our business and for the sector at large. Waste to value and renewable fuels. When China stopped buying our plastic and recycled goods, money started flowing into projects that could help fill those needs domestically and otherwise nearby. So yeah, a lot of innovation there. To your question specifically about service, ESCOs and service companies that are providing business models that make it easier to take advantage of those things. Absolutely, it's like I said, it's sort of a nonstop process of innovation.
Got it. And any thoughts about where we might see carbon prices going in markets like Reggie or the California cap and trade or?
Yeah. So broadly, I mean, so it's a little bit. I don't want to give the wrong impression. If you think about the dynamic as the economy decarbonizes, that's not necessarily going to mean that carbon credits themselves are going to skyrocket in price. The more effective programs at home in the US and abroad typically have bounds set on pricing, a floor and typically a ceiling that acts as like the sort of opportunity cost tax that one could pay, so to speak. And, a well-run carbon program will appropriately price those instruments over the course of time. There's volatility there for sure. COVID created a lot of front of the curve volatility because of the drop off in economic activity. And then, in carbon world, production of carbon, and in renewable energy credit world, consumption of energy. That sort of volatility is normal in markets. They go up, they go down. Broadly, though, the trend goes like this. That's clear on a long enough time frame.
Got it. So we're approaching the end of our half-hour session. I want to turn it back to Ed in a second. But Jonathan, I just want to say thank you so much for joining us today and give you a chance if there was a question you wanted to answer that I didn't ask you, by all means take this opportunity to address it.
Sure. No, this has been great. Really appreciate you guys having me. And I think I've said most of what I'd like to. Again, the news is really good on this, in our part of the world. And we hope that, spreads across the rest of the economy and, the country. But, there's opportunities here. The growth and the value over time are very, very clear. And we're excited to continue being at the forefront of it.
Thank you so much. Ed, let me turn it back over to you.
Jacob, thank you. And Jonathan Bernstein of Carbone, thank you for being with us today. And thank you for what sounds like good news ahead for these markets. We could use some good news certainly this week. So it's great to have you on. Thank you again for all of our listeners. We will see everyone next week at the same time. And until then, everyone stay safe. And thank you again to both our host and our panelists. Bye-bye.
Thank you all.